So there are probably three things that are important to us in investing in a business. One is we want companies of very high quality, and by that I mean a business that has the ability to invest incremental capital for very high rates of return. So a business that doesn't require a lot of capital to go in, but has the ability to spit out a lot of cash. The second thing we want is prospects. So a great business operating in a market that is growing, or a great business operating in a market where it has the ability to grow by taking share off other competitors. And the final thing we look for is price. We want to be able to see that the price at which we can buy that business is less than what we think the business is really worth. So where those three criteria are satisfied, and they're not often satisfied, but where they are, that's the sort of business that we try to own. So it's really driven by the same factors. So often we will exit a business when the price runs to a level at which we think it's no longer good value, or a level at which we think we can find better opportunities. Less commonly, we'll find that we were just wrong about the quality of the business, or about the prospects of the business. Those two tend to be fairly stable. A good business doesn't usually become an ordinary business or a bad business overnight. They tend to be relatively robust. But there are times where more information becomes available, and it becomes clear that an industry structure is changing, or we might have overestimated the quality of the management team, or there might be a dynamic at play that we come to appreciate more over time, and come to feel that threatens our thesis. And it's one of the most difficult things to do once you've done the work on a business and become comfortable with it, is to let go of that thesis. And it's one of the mistakes that fund managers can make in becoming too attached to stocks. We try to have as much discipline around that process as we can, and every month we review the portfolio with a view to actually ranking the opportunities in the portfolio in terms of those dimensions that are important to us. And the businesses that rank down the bottom end of the portfolio, we form an agenda around those, and explicitly ask the question: is it time to let these go in favour of some of the other opportunities that we might be able to see that are preferable? The most burdensome things we do is holding cash, and I say it's a burden because we have no ability to predict the short-term movements of the market. And if we're holding cash and the market runs, that hurts us, and it has tended to hurt us over the years since the fund has been running. But we do that because when equities become expensive, we know that over very long periods of time that the investment experience is not going to be as attractive as we would like it to be. And we know that somewhere down the track, we don't know when, but somewhere down the track, equities are going to be cheaper. And we'll have an opportunity to deploy that cash at more attractive prices. So we do hold anywhere from 0 to 30% of the Montgomery Fund in cash. In recent times, we've been in the 20s, so we've been towards the higher end of that range. And that is, again, that's uncomfortable because equity markets tend to go up, and cash holds you back when interest rates are low. But if you look beyond the short term, we think it makes sense to have that flexibility, and we think it makes sense to try and capitalise on the opportunities that we know will arise at some stage. Yeah, it saw us deploy a bit more cash, but what we found is that a lot of the names that we own, the good quality businesses that we favour, they weren't as badly affected in that downturn as a lot of things we don't own. So our portfolio didn't actually get a lot cheaper, which was great. It meant that our relative performance was very, very good, but it was also disappointing in that we didn't see the opportunities we might have hoped for to deploy more of that cash back into the market.